Welcome to the debate. Today we're diving into, well, a deal that really does seem to redefine infrastructure investment, certainly for this century. Nvidia's massive commitment to OpenAI. We're talking non-voting equity, yes, but also a pledge to deploy, get this, 10 gigawatts of Nvidia computing capacity. The total commitment, up to $100 billion. It's easily the biggest financial handshake we've seen in tech for a long time.
The scale is, it's staggering. Though maybe misleading is a word I'd use.
It is staggering. And that brings us right to the central question we need to tackle. Is this commitment, this huge investment, an absolute necessity? Is it crucial for achieving the kind of scale we need for next-gen AI, really a strategic push for innovation? Or is it fundamentally something else? A market-distorting act, perhaps, marked by, well, circular financing and anti-competitive consolidation. My position, I lean towards the former. I see this as a necessary, strategic response to what are truly unprecedented financial and, frankly, engineering barriers facing large-scale AI right now.
And I come at it from a different angle. Look, the need for scale, that's real, absolutely. No argument there. But I argue this specific partnership raises some pretty profound antitrust questions, and sustainability concerns too. What we seem to be seeing is a dangerous concentration of market control, and it's underpinned by a financial structure that looks, well, let's just say it looks suspiciously like classic round-tripping.
Well, let's look at the numbers, because I think they really speak to necessity, not just, clever strategy. The sheer capital required for these foundational AI projects today, the traditional financing models, they just don't cut it anymore. The industry's sort of hit a wall where only really a handful of firms can actually afford the chips, build the data centers, pay for the colossal power requirements. This deal, it provides absolutely crucial funding for OpenAI's massive infrastructure expansion, which, by the way, is projected to burn through something like $8 billion in cash just next year alone. Analysts, they tend to view this investment as a necessary, even a wise use of Nvidia's substantial free cash flow. It helps secure long-term demand visibility for Nvidia, sure, but it also ensures that the push for that next leap forward in AI doesn't just stall out because nobody can foot the bill.
Okay, that's a compelling argument if you focus just on the financial size. But have you considered the structural implications of this kind of entanglement? My core thesis here is that you're effectively uniting two entities that control the absolute critical choke points in the AI ecosystem. You've got Nvidia controlling maybe 80 to 95% of the essential chip market, the hardware, and then you have OpenAI leading the charge on model development. And now, Nvidia doesn't just supply them, they hold a massive financial stake in arguably their largest customer. This creates intrinsic anti-competitive incentives. It just does.
Or you could say they are mutually invested, which drives alignment and, frankly, efficiency.
It drives exclusion. Look, antitrust experts are deeply concerned, precisely because of this financial interest. When a dominant supplier like Nvidia also holds equity in a major customer like OpenAI, there's an immediate, almost unavoidable incentive for that supplier to, well, maybe not sell chips to or maybe not grant the same favorable terms to that customer's competitors. Think about the message that sends to smaller, innovative AI startups just trying to get access to the same finite supply of GPUs. The Department of Justice, they're actively monitoring this space, focusing specifically, and I quote, on preventing exclusionary conduct over the resources that are needed to build competitive AI systems and products.
Right, and this brings us, I think, to the core tension, doesn't it? Is this exclusion, as you say, or is it enablement? You're highlighting the risk, the preferential treatment possibly stifling competition. I frame this partnership as maybe the only practical mechanism right now to accelerate the kind of infrastructure deployment that ultimately benefits the entire industry.
But see, the benefit to the entire industry, that feels secondary to the immediate direct benefit to one partner, doesn't it? The DOJ's mandate, it specifically targets behavior that forecloses access to key inputs. So if a competitor of OpenAI faces a longer wait time or maybe higher prices for the exact same hardware because Nvidia is prioritizing its massive internal financial partner, well, that is foreclosing access, plain and simple.
I have to disagree that this is simply about prioritizing one customer over others. This deal, fundamentally, it's about accelerating the deployment of infrastructure capacity that is just monumental. We're talking 10 gigawatts of computing power using their upcoming Vera Rubin platform. That number, 10 gigawatts, it's almost hard to grasp. It's roughly the power consumption equivalent of maybe a mid-sized city, dedicated purely to AI. The sheer engineering scale involved means these projects simply cannot be financed or built quickly enough without commitments of exactly this size. And this scale, it isn't just for OpenAI. It sets a new baseline for global AI infrastructure. It pushes the boundaries required for the next generation of models, which, let's be honest, will likely require sustained petaflops, maybe even exaflops of compute.
Okay, the commitment to that infrastructure, that is exactly what we need to scrutinize, especially the financial architecture behind it. The risk isn't just the scale itself, but the financial terms. If Nvidia has to provide up to $100 billion in capital, that then essentially translates directly into revenue spent on its own chips, well, the fundamental sustainability of that growth trajectory becomes really questionable, doesn't it? You're basically using your own balance sheet to artificially prop up the demand metrics you need to sustain your valuation.
I think calling it artificially propping up demand is maybe a bit overly dramatic. This investment, I see it as a prudent, calculated use of capital. Look, given Nvidia's massive cash flow and also the very real regulatory limits on deploying that capital through, say, large-scale acquisitions, which would face immediate antitrust scrutiny, we all know that, securing a massive, long-term anchor client like OpenAI, that's just good business. It secures future earnings, yes, and it gives them unparalleled visibility into long-term demand.
Respectfully, though, securing an anchor client usually means the client commits their own capital to lock in supply. That's how it normally works. In this scenario, Nvidia is effectively paying the client $100 billion to lock in their own supply channel. That completely changes the definition of demand visibility, doesn't it? That structure is precisely why analysts have raised these acute concerns about round-tripping financing.
I'm still not quite convinced that analogy fully holds up here.
I'm sorry, but I just don't buy that it's entirely benign. Let me tell you why. We have to challenge this financing mechanism directly. Think about it this way. Nvidia provides up to $100 billion in capital, this non-voting equity, to OpenAI. Okay. OpenAI then immediately turns around and uses tens of billions of dollars to buy data center capacity and systems, which means spending roughly $35 billion per gigawatt directly on, guess what, Nvidia chips. Nvidia is providing the capital that then becomes their own revenue.
It is, yes. It's a closed-loop system, certainly, designed for efficiency, but
it bears striking and, frankly, worrying similarities to the vendor financing practices that were absolutely rampant during the dot-com bubble. Remember that? Back then, you had tech companies lending money to smaller partners who would then use that money to buy the tech company's own equipment. It generated seemingly organic revenue growth, but it was built on subsidized circular debt. Market observers today are rightly questioning whether there's, quote, real value behind substantial spending commitments when the supplier is essentially bankrolling the purchaser. OpenAI is taking on capital from its key supplier to finance its own investments, which in turn effectively ensures future earnings for that supplier. It feels like a structure built to pump up revenue projections, not necessarily reflecting pure organic market demand.
okay, well, I do acknowledge the historical parallels, those bubble comparisons. We absolutely must draw a strong distinction based on the tangible assets involved here. The dot-com era, let's face it, was often built on vaporware, on inflated software contracts. This investment, however, is tied to concrete, physical hardware deployment. It's tied to long-term infrastructure goals. 10 gigawatts of real capacity coming online starting in late 2026. This isn't debt based on empty promises. It's arguably secured revenue streams tied to the construction of massive physical data centers. And the market reacted positively, didn't it? Pushing Nvidia's valuation towards $4.5 trillion reflects, I think, a belief among investors that these secured revenue streams are tied to something real and necessary.
Investor confidence is one thing, yes, but systemic risk is quite another. And that brings us back to the fragility caused by market dependency. We already know, based on their filings, that Nvidia's two largest clients account for nearly 40%. 40% of their quarterly revenue. That level of customer concentration creates an extremely brittle situation. If either of those huge clients encounters a hiccup, or perhaps more worryingly, if this circular financing model becomes regulatory exposed, the impact on Nvidia's performance could be severe. This concentration alone highlights, I think, the critical necessity for robust regulatory intervention now, before this market structure becomes completely irreversible and fundamentally anti-competitive.
That's a valid point regarding concentration risk, I'll grant you that. But it also, interestingly, underscores the tremendous competitive pressure Nvidia is actually facing, which is, of course, the natural market response to any perceived choke point. That competition, I believe, naturally mitigates the risk of long-term dependency you're worried about. We are seeing real, viable competitive alternatives emerge across the hardware spectrum.
Alternatives are emerging, yes, I agree. But are they emerging quickly enough to actually counter this specific strategic alliance?
I think they're scaling rapidly. Look at AMD, they're aggressively gaining traction with their MI300 series chips. Intel is effectively targeting the cost-effective enterprise solutions with its Gaudi processors. And perhaps most critically, the custom AI chip market, the ASICs, developed by massive players like Google, Amazon, Broadcom, Marvell. That market is projected to nearly double this year alone. These custom chips are designed specifically to reduce reliance on the singular Nvidia architecture. And let's not forget the geopolitical pressures either. Huawei's Ascend chips are becoming a significant alternative in key global markets, particularly in China. So competition is addressing the choke point problem and from multiple directions simultaneously.
Okay, while those alternatives are indeed growing, and that's positive, it doesn't really change the immediate, present danger of this deal, does it? Nvidia is arguably using financial entanglement with the current leading model developer, OpenAI, to solidify its dominance right now, potentially foreclosing the market precisely at the moment when competitors most need fair access to resources to scale up themselves. The financial incentives to prioritize the partner who just effectively handed you a potential $100 billion commitment over, say, a smaller startup trying to buy just 100 GPUs, those incentives are undeniable. This deal feels designed, at least in part, to cement a kind of duopoly on AI's essential infrastructure before true broad competition can really flourish.
Look, I still maintain that this partnership is a watershed moment, one that addresses the vast, almost unimaginable scale requirements of modern AI. Deploying 10 gigawatts of global computing capacity isn't just some optional nice-to-have. It's rapidly becoming a necessity for the next phase of AI development. The capital deployed here, I believe, is essential and pragmatic. It allows two industry leaders to push the technological boundaries in a way that ultimately benefits research and application across the entire spectrum.
I see why you frame it as necessity. I really do. But the fundamental debate over whether this specific arrangement constitutes, market manipulation and harms competition protection, that remains crucial. The questions about whether this circular financing model and the resultant concentration of power actually harms the long-term sustainability and competitiveness of the broader AI ecosystem, those questions have to be addressed by regulators, and right now, they remain very much unresolved.
It certainly forces us all to examine that very tight tension, doesn't it? Between promoting the rapid, enormous-scale innovation that, yes, this investment enables, and, on the other hand, maintaining genuinely competitive open market structures.
Exactly. And balancing those two competing pressures, that speed versus fairness calculation, that really is the ultimate challenge facing not just the industry, but regulators as well, today and going forward.